All right, we are live. So, double check, double check. Well, that's always fun too. Check the channel. All right, good. So, with that being said, I am Brandon. I have joining me my co-host Mark, and this is Invest for Life. We got a little bit of an episode here for you guys today. We have some first topic is going to be the Hummer EV, and then we're going to talk about dividends, what they are, and why or why not to invest in them, and maybe even which ones might be good or bad. So, without further ado, we'll go ahead and jump right on in. Mark, how you doing today?
I'm doing well, Brandon. So, well, we're going to talk about a little kind of continuation from last Stock Talk episode 1, where we kind of talked about Tesla and some of their battery day stuff. Now the big news is this new GMC Hummer EV. So, Brandon, what do we think is going to happen here?
So, with that being said, the Hummer EV, we'll kind of go over just a few of the specs real quick. And is this a competitor? My guess is this is targeting mostly the Tesla Cybertruck. So, and a couple of other vehicles beyond that. So, it has things like it can raise its suspension. It's made for an off-road vehicle, which is interesting for an electric vehicle. We haven't really seen that yet. It has things right here that you can see. It says crab walk, extract mode, ultra vision, so what that means is the tires can actually rotate the same way and actually crawl out. Extract mode, the vehicle lifts up to get over obstacles, and then ultra vision actually has cameras underneath the vehicle. And then of course the GM estimates right now that it's getting 350 plus miles. This thing also has things like 1,000 horsepower, which is actually not a joke. Like legitimately, the three motors in it legitimately give you 1,000 horsepower, and it says 11,500 foot-pounds of torque, but it's actually, when you do the conversions, about 1,000. Watts to freedom. What does that mean? It goes 0 to 60 in 3 seconds. It has an infinity roof like a Jeep, and then Super Cruise, so it has their version of kind of self-driving. So why is this vehicle important? Well, this is the first or second vehicle that really is compelling in an EV truck to really buy. The Tesla Cybertruck was definitely a compelling answer for a lot of people. Me personally, not necessarily. But this is one of the first trucks that I've thought, I want that, and it's an EV. So that is where it could possibly impact Tesla. It has a reputable company, GM, manufacturing it. It has all these specs that are claims right now, and we'll see if they live up to it, of course. And then it's also got a stylish look to it that is more traditional vehicle. What are your thoughts?
No, I completely agree. I think this is where, I mean, you've seen other car manufacturers come out with an EV vehicle. I don't really think they're that popular though. You know, and there's like the Hyundai Kona, and they always have the Prius and stuff like that. I think this is kind of getting to the realm of the everyday consumer. I mean, I know a lot of people who like the open like Jeep concept, which the Hummer has. And the biggest thing here is, we talked about like how Tesla kind of changed the narrative on EVs last time. The Hummer was like your classic go-to joke about horrible gas mileage.
Yeah.
And now all of a sudden you have an EV Hummer.
And before, just to interrupt real quick, I think it's actually a genius move, because you had a lot of people that are out there thinking, oh, I would love this vehicle if it had better gas mileage. They've taken that and flipped the script completely, which I think is something that people always appreciate. Go ahead.
Oh, 100%. And that's exactly where my point was leading, was that this is that narrative changers. There's definitely a shift in the culture to cleaner vehicles. And I mean, we can get into a big discussion about like how clean are EVs and stuff, but as far as carbon emissions and everything, there's a massive shift to it. And now you have Hummer, like the classic horrible pollutant car, is now an EV, and it looks sharp, and it has crazy horsepower and all kinds of stuff. And I mean, for me personally, I think the Cybertruck kind of started doing that things. I don't think it looked good. I mean, no jab at Elon there. I just think it was an ugly vehicle, but this Hummer looks cool. and it looks clean. And I mean, so it's got a lot going for it. So I think we're going to kind of see a thing coming up where we kind of see other major car manufacturers maybe coming out with some of their classic cars just as an EV. And that I think could really affect Tesla stock.
Yeah, I think this could be and now I don't think in the long term. I think Tesla still's got enough of a foothold. They are known as the EV manufacturer, so I don't think it's going to kill them. No, that's not what I'm saying. But they'll take a dip and then they come back up. It all really depends on how well they're able to execute. GM does not have the infrastructure to build EVs quite yet like Tesla does. They have it to make cars, yes, but the battery packs and things like this that they're right now importing from other companies. The LG is the ones who make these batteries. They're still having to rely on other people. Whereas Tesla, yes, they're relying on Panasonic, but they've already got these lines open. These chains are already flowing with other vehicles. So it's real easy for them to get more. Exactly.
Tesla's still by far in a class of their own. But I mean, like I said in the last episode, which you guys can go back and watch, the big thing right now is Tesla has the EV market share. If that were to start slipping, that's the only way this would really affect Tesla stock. If anything, people may, they're going to be like, you know what? If I'm going to get an electric vehicle, might as well get a Tesla. If anything, it may push more people to consume and buy Tesla vehicles. So you never know what will happen. But I think it looks sharp, and I think we're going to kind of see a big shift in the next few years. This isn't going to be like an overnight thing. In the next 3 to 5 years, I think the EV market, I think it's going to be a big thing.
Oh yeah, and I just threw up according to Gathered, Tesla has about 81.66% of the EV market share during the first half of 2020. So that's a big stat. That's no small feature. People are trying to chip away at that. So it even comes with a little bit of graph. Now this is not my graph here. I'm getting this from Google, just straight from Google. Oh well, there it is. Okay, perfect. So. And it kind of gives you a breakdown of all the other ones out there. And Tesla is literally the top 3, bars in this category of the vehicles that are sold by the set. And then second, of course, Chevy Bolt. So, in that case, you can make the argument, maybe Chevy does have a little bit more than people are giving it credit for. And then, of course, another Tesla in the back. But maybe Chevy's like, hey, we actually have been making these vehicles for a little bit longer, just under the radar. Maybe we can make an impact on Tesla. So I think this is great because you know what? Tesla's done a great job at keeping their prices and lowering their prices on their own, but nothing gets prices competitive like competition. So with another competitor making more vehicles, that's only good for us in long term. Of course, right now it doesn't seem like that because it's $112,000. Hold on, let me see what happens when I go to reserve. I think it pulls me to a page when I try to reserve it, and it tells me exactly what the pricing is for these vehicles. There it is. Okay. So you have $112,000 for the Edition 1, $99,000 for the Hummer 3X, which, by the way, only gets 300 miles, and then at $89,995, whatever, for the 2X, and then for the EV2 is $80,000. That only gets you 250 plus miles. We'll see how these numbers and statistics change as these things actually come out. But nonetheless, this is the one that everyone wants. This is the one that they're touting. It's the only one with all of the features that everybody is like, oh my gosh, 3 seconds in a vehicle, 0 to 60, amazing kind of thing. So,
yeah, no, I mean, and it looks great. No, like I said, I'm going to be very curious to see what will happen as time progresses.
Yep. All right. So with that being said, we've done about 9 minutes, 10 minutes on that. So is there anything else you want to add on to what this means for the EV market, Tesla and GM?
No, I mean, not too much that we haven't already touched on. I mean, like I said, competition, I think is a good thing for us. And even for Tesla stockholders, like I said, as we see a shift towards electric vehicles and that little graphic that we threw up earlier from Google, Tesla has a huge market share when it comes to EVs. Even if that lowers a little bit, I don't think Tesla's going anywhere anytime soon. They have a nice little head start on most of these other companies. They have a lot of their own little niche products. They don't really have to rely on as many other companies. So I think in the long run, Tesla is still going to be a good company. GMC's got that going for them. And I mean, like we mentioned, some other car manufacturers already have their own EVs. So I think the entire market is just going to be growing over the next few years.
Oh, I agree. I just want to throw up their stock pricings real quick between the two of them. Tesla at $420 per share, GM at 36. So, if we want to talk about, we're going to lead this into our next segment here as, like dividends and long-term owning these. I think Tesla has farther to come down before they go up. GM has farther to go up before they come down. At this point. Now, this is not, and before we really get into start talking about stocks, dividends, and whatnot, we are not necessarily stock professionals. We are not, we do not have licenses to do so. So everything we're doing is research that we've learned on our own and are trying to pass along to you guys.
Correct.
So GM
this is not stock buying advice. This is just a conversation about different stocks.
Mm-hmm. And actually, Robinhood doesn't have Tesla at a dividend, but we have a 3.1 dividend yield for GM. So I don't know if that's actually true. I think Tesla does actually give a dividend. But I'll go ahead. I'll let you start off with the dividends. You want me to share your screen?
Go for it. So one thing that we like to do at Invest for Life that we value a lot is education. So Brandon and I have been investing for a couple of years now. And, one thing we want to do is share some of the things we've learned with you. So one thing that we've learned a lot about in the past are dividend stocks. So if you're new to investing, or even if you've been around for a while and want a little bit of a refresher, you've probably heard about dividends your entire life. And you're like, what exactly is a dividend? So a dividend is a share of a company's profits that they return to the shareholders with a direct payment. It's literally some of their earnings that they turn around and give back to you for being a shareholder of their company. And why do they do that? It's to reward you for investing in their companies. You're putting your money and giving it to them, saying, hey, I trust you guys to use this well. And they say, thank you for your investment. We're going to reward you with either higher share prices or with a dividend, or ideally both. So then you can get into like, why do some companies pay dividends and others don't? Like we just saw there, Robinhood didn't have Tesla paying a dividend, whereas GM did. The main thing is that if a company doesn't pay a dividend, they usually have a corporate philosophy that they reward their shareholders with actual capital appreciation. Their stock price will increase in value. If a company doesn't increase as quickly, they're considered more of a value stock, you can kind of call them. They usually pay a dividend to reward their shareholders because they aren't appreciating in share price as quickly, they're not growing as quickly. So why would you want to invest in a dividend company then? Simple answer, compound growth. Basically, what's going to happen is if you invest in a dividend company, they will reward you with a dividend. You can then reinvest that dividend, then they will pay you more of a dividend, and the cycle continues. So what I have here is just a little thing I'm in Excel, piece of cake. So imagine hypothetical scenario. You put a $10,000 investment into a company that averages a 7.5% annual return, which is not unreasonable. I think the S&P 500 actually averages, I think, slightly more than that last I checked. So what I have here is a couple examples. So the first one is this kind of blue line. This is if you just have that 7.5% growth. So $10,000 investment, after 25 years, you are slightly over $60,000. And this is one of the reasons why I am a big fan of long-term investment. This is where you want to look big picture. $10,000 may seem like a lot of money to new investors right now. If you're an experienced investor, it may not seem like that much money to you. But the fact that it can go from $10,000 to $60,000 is a big thing. Or you can think about it, that's the same thing as $100 going to $600.
Yeah.
That, it's a big deal. And you may be like, oh, it's going to take 25 years though. Now, if you go, okay, well, that's $1 million to $6 million in 25 years.
Yep.
But let's get out more than that. Okay, so say you have that 7.5% annual return plus the dividend payment of 1.5% dividend yield. We just saw GM was 3%. So 1.5% is not even outrageous. Most dividend stocks pay more than that. We're going to give a couple examples of some companies later that do. But this is if you just accept that payment and don't reinvest it. You have this orange line. Same thing this nice little exponential growth here, you end up with just over $70,000. So just that 1.5% dividend yield after 25 years is 10,000 extra dollars. Now, the scenario that I do and I'm planning on, so when I'm actually in my 40s, 50s, 60s, these companies that I invested in when I was 19, 20, 21, that's when I'm at that 25-year mark. This is money that I'm reinvesting. $10,000, and this is not $10,000 a year. This is just $10,000 one-time shot. And you reinvest that 1.5% dividend yield, you end up with like $87,000 after 25 years. And now imagine you do this out for 40 years. You're looking well past $100,000, $200,000. It is crazy how the dividends are paying you. You reinvest the dividends, and then you get more dividends in return for that. I'm a huge, huge, huge fan of dividend stocks.
Yes, and so I have a similar graph that I actually found. I'm gonna go ahead and share my screen real quick. Now, Mark, who has not seen this, this will be new to him. I actually did a dividend calculator. So I started out with $2,000 here, invested annually $600. Now I gave it a 5% dividend rate, which is I'd say a little bit on the high side, if I'm not mistaken. And then a share price. I think this is exactly what you did. 7% increase in share price per year. You there?
Yeah, I'm here.
Okay. And so if you want, we can mold some of these numbers maybe to be a little more realistic if you see something a little popped out. But I did it over 30 years.
Okay.
What I found, so at year 10, you have $16,000. Now, don't forget, you're only putting in $600 a year with an initial investment of $2,000. You go to year 20, you're at $60,000, and then year 30, you're at $205,000. Now, this is not a huge amount that's being invested into these, although it is a pretty good dividend stock, I would say, due to the higher yield. But you have the total dividend income, $12,000 you've made just from dividends alone. By itself. I think that is powerful. That's in 30 years. We'll go 10 years. That's $700, $763. That's more than you're investing in every year. But and then by year 20, of course, now you're getting to that compound portion. You got $3,223. And then, of course, your yield, you're getting 69.33% over that time. I just think, and then, of course, you have the entire 30-year breakdown right here. And you can pause it if you wish to read into any of these numbers. I think this is absolutely fantastic. And I love stuff like this to really kind of get you excited. Like, this is why you want to actually, maybe pay attention to some of these things and really start focusing on investing in a certain area. And hello to our one viewer, by the way. Let us know if you have any questions. We're talking dividends right now. And kind of what they mean, why they're important to invest in and whatnot. If you have any questions, please let us know in the chat. Okay, I'll throw the screen back to you, Mark.
Yeah, man. So we're gonna go through a couple examples. So my favorite two dividend companies are Johnson & Johnson and Procter & Gamble, and I will explain why, and then we'll talk about a couple ETFs afterwards, just so you guys have an idea of what we look at. So I do a lot of my research either through Charles Schwab or through Yahoo Finance. And Yahoo Finance is a fantastic tool to use and do some research. So, and it's free, which is even better. So Johnson & Johnson, their closing share price on Friday was $145.24. They pay an annual dividend of $4.04, which is a 2.78% dividend yield. So the example I just gave about a $10,000 investment with a 1.5% dividend yield, Johnson & Johnson pays more than that. So not only that, if you look over, this is over 5 years, a lot of up and downs. It's one of the perks of being in the healthcare industry and stuff like that. But 5 years ago, they were down in like 100. So that one share gained $45 over 5 years, plus then you got paid $4. And even better, they have been increasing their dividend for quite some years. So their ex-dividend was August 24th. So if you held that share, or if you held shares of this company before August 24th, then you qualify for their latest dividend. So if you go under the statistics tab, you can find out some more information about the company. Give it a second to load. And so, like I said, Yahoo Finance is just a great tool to use.
When it loads, of course.
My Wi-Fi is just, stellar as it is. Okay, cool. There we go. Alrighty, so it gives you some of their different ratios, their, market cap, their PE, their PEG ratio, all this other stuff. But what I want to highlight is if you scroll down a little bit to their dividends and splits tab. So their forward annual dividend rate and their trailing dividend rate. So forward, talking about the next 12 months, trailing is the last 12 months, and you can see that it's increasing. That's always something that's nice. That means this company has been raising their dividend. Gives you their forward yield, their trailing yield, that's just based off of that other stuff that I just said. Their 5-year average is 264, so they're now at $4, which means they have been increasing steadily over the past few years. And now this is the one thing I want to draw everyone's attention to is the payout ratio. Because this right here will tell you if this dividend is sustainable. There are some companies that are like, we pay a 15% dividend, but they're paying like 400% payout ratio. What is the payout ratio? This is what percentage of their earnings are they giving back to their shareholders. If this is over 100%, that means it's not sustainable in the long term. It means they're paying out more than they're actually making, and that's not a good business model. 61%, that's pretty sustainable. That means 39% is going to other financial things, whether it's reinvesting into R&D, whatever else it may be. So that is not bad. The lower it is, a lot of you'll see Microsoft, Apple, NVIDIA, some of these other tech growth stocks that pay a dividend, their payout ratio is a lot smaller. It's in like the 10, 20% range. And that's because most of their earnings are going back into research. So my next one that I want to show out is Procter & Gamble. This is another nice company. They just make so many household products. They've been around forever, and they will be around for some time to come. Mm-hmm. They close at 142. They pay a $3.16 annual dividend at 2.2% annual. So once again, both of those examples right there were over 2%. The example I gave with that compound growth was 1.5%. So just think about how much more these guys could have given you.
Oh yeah.
This one was nice and loaded. Oh, I take that back. Oh, there we go. Loaded a lot quicker. Thank you, Yahoo Finance, for working with me this time. And their payout ratio is actually only 58%. So that's even better. And so that's just things you want to look at. If a company has a super high payout ratio, it's not necessarily a bad thing. If you look at like AT&T, theirs I think is over 100% last I checked. They're struggling with their DirecTV thing right now, but with the growth of 5G, if AT&T can increase their income, it will decrease that payout ratio. And if they can get that back to a normal level without having to slash their dividend, they wouldn't be a horrible one. Once again, this is not stock buying advice. We are not professionals. This is just things that we have learned that, we want to share with you guys. So Brandon, do you want to talk about a couple ETFs that you have found?
Yes. So now I would like to transition and just kind of really talk for a second about dollar cost averaging, what that is, because I'm going to kind of like tie this in. Now, dollar cost averaging, and I just kind of found it on here. Dollar cost averaging is where you set aside a fixed amount in regular intervals of money, regardless of circumstances. Dollar cost average is by long-term investors usually used. So if you're investing a certain amount every month, you're buying shares in good times as well as bads. So it helps kind of average out the goods and the bads, which is the idea. So I try to find companies that are not super expensive, but have high dividends, because I want to incorporate my dollar cost average with investing with a few stocks that are not necessarily super high in price, so I can own more of them over time, but I can also get a pretty good dividend from them as well. So I found a couple, and just the first one's up on my screen is actually the Vanguard High Dividend Yield Index Fund ETF shares. Now, would you like to explain what an ETF is, Mark?
Sure thing. So an ETF is an exchange traded fund. So a fund basically is a company basically has this pool of investors' money that they buy the shares of these companies. So if you buy a share of this fund, you own a fraction of a share of all these other companies.
And I
The
have those
funds
pulled up for you.
have different strategies that, and they explain all of this on, if you look up the funds. One thing you want to look about fund is their prospectus. It tells you what is their investment strategy, which indexes are they tracking, what is their goal, kind of thing. And exchange traded fund differs from a mutual fund in that you don't have to hold it for a certain amount of time. Usually you can trade it that same day. The price of the fund changes throughout the day, whereas a mutual fund gets updated once a day. And there's some other minute details, but that's kind of the big thing. The difference about holding a fund versus an actual equity is a fund usually has an expense ratio that we'll kind of talk about and look at a little bit for these examples as well.
So I'll go ahead and continue here. Now, the Vanguard, they have, it's kind of funny. I actually found this fund before I realized exactly who they were holding. And then that just so happened to be the ones that Mark, you were looking into as well, which is kind of funny. Their top ones: Johnson & Johnson, Procter & Gamble, JP Morgan, Verizon, Intel, Merck, AT&T, Pfizer, Comcast, Bank of America. So that's our top 10 holdings. But if you look, they're only the maximum amount, Johnson & Johnson's 4% of their assets. 3.3 is Procter & Gamble. So it's not like they're super overinvested in any one area, which they do have limitations. I believe it's like 10% max or something like that they can do, but they're even below that, which I like. I like that they're very broad. They're looking for good. So
you get a nice basis. You get the diversification of a fund. You always hear about diversification when it comes to investment. Kind of hedges your bets a little bit. If you're like, I like Johnson & Johnson, but I don't want to put all my money and all my eggs in one basket, funds is a nice way to do that because they are spread out.
And then these guys are also $83.86 to own a share with a dividend. Let me see, 3.55%.
Yep.
So they are overall, that's a good way to go. And then if you go, I believe if I go maximum 5 years, you can see up until, well, they did have a little bit of a crash back here, but up until in general, the COVID hit, they actually were doing pretty well. They were slowly increasing. So if you had invested 5 years ago, February 1st of 16, up until December 19th, well, you're looking at, what is that? 64.93. So you're looking at about a $30 increase on just those alone. And then of course now everything hit and they're back down to 83. So,
and even better, if I'm reading it correctly, it looks like the expense ratio for this one is 0.06%. And that is incredibly low for a fund. That is a fantastic expense ratio. So this is not one where you're losing money due to fees or anything like that.
Yep. And then we'll go over to the other one that I found, which was the Schwab US Dividend Equity ETF. And again, we'll just go right, since you mentioned that before, a 0.06 expense ratio with a dividend yield 3.42. A really very similar as far as the stock goes, more consistent growth. So in reality, as far as they didn't have as many dips. They did have that same dip at December of 18. It looks like there was obviously there's a little bit of a hiccup there with both of them. And then of course with COVID, but these guys have actually recovered way more than Vanguard has since COVID hit. And hopefully that means that they will continue to recover as everything else does as well. And you can see, of course, down here, the trading volumes and whatnot. However, we'll go over to holdings real quick. I like how fast my internet loads on stuff like that.
That's
nice. So these guys own stuff that I like as well. So you're looking at now. I actually USP or UPS in general. They own Qualcomm, Texas Instruments, Pfeiffer again, Pepsi, BlackRock, which I actually not really sure what BlackRock is.
They're an investment firm. It's a financial institution, basically.
Oh, yeah. Well, they have 3M, Coca-Cola, and Verizon. So actually they're different, but they're not too different. And then
I guarantee you, if you were to look at past the top 10 holdings of the other ones, they're probably all a lot similar companies, just different weights. And that's the thing that you want to look at when it comes to funds like this is you want to see, are they heavily weighted in a specific sector? Are they heavily weighted in a specific company? And kind of hedge your investments that way. But once again, funds is a great way to get some diversification. You just do have to look at their expense ratio and if they have any fees, or if it's a mutual fund, make sure that, if you have to hold them for 90 days or something like that, that you're financially able to do so, and that is your plan, is to keep your money with them. ETFs, you shouldn't have to worry about that too much, but always just double check before you buy into any of these. So, once again, dividends is a great way to make money off of investing, because the companies are paying you. It is putting your money to work. It's not just sitting idly by. It's your dividends are making money, and then that money will make you more money, and 10, 20, 30, 40, 50, 60 years down the road, they will still be making money.
Yep. And I was going to go dividend yield. I was actually going to do a quick on that one there. So if you had, no thanks, let's just say that original $2,000, we're going to use that one as an example. Annual contribution, let's say you can put $100 a month, so that's $1,200 a year. Let's see, per share appreciation. And how much have these guys gone up in the year? Let's see. Doesn't necessarily give me where the year-to-date total return, negative 8.21%. Yeah, that's pretty much expected. But, and we'll go 3% on the calculator, wherever I put that. Perfect. Over 20 years, you're looking at, again, 442,000. Of course, I didn't change anything up here, but just at the 3% annual yield kind of thing, to more accurately portray what we were talking about, to actually portray it actually in an actual stock, and to kind of show you guys a little bit more there in a calculator what that would look like. I got to get better with that particular calculator. However, that's the idea, is of course you invest certain amounts, and you just continue to invest it in something like this. And if you're only investing $100 total in stocks, maybe you don't want to make that all of where your money is going. Diversify it a little bit. That's fine. Put like $20 in every month and just kind of let it grow into one, split it. So $10 into each. You find 2 dividend stocks that you want to go with, and then ones that are growing. So you can choose the actual companies themselves, or you could choose something like an ETF. You have plenty of options, but hopefully now you have a better understanding. Some places to start doing your own research, because remember, we're not telling you what to buy. We're trying to give the information we've learned about things that we have learned to you, so you can make your best decision.
Exactly right. And so if one of those things, Yahoo Finance is a great tool. That dividend calculator is a great tool. That's what we're here for. Is we're here to help you learn first. That's in our motto. And that's what we're here to do.
Actually, let me see. I can probably pull that up. So for all those who don't know, don't forget to like and subscribe to our channel as well. We are brand new, so we might be a little bit rough around the edges with some of this technology. I have other channels that I've worked on, but that doesn't mean I don't make mistakes, just like everybody. Let me see if I can find out. There you go. Learn first, invest income, achieve growth. And this right here is what that subscribe button looks like. If you've never seen it before, I highly recommend go ahead and click on that, and then don't unsubscribe. But with that being said, do you have anything else to add on?
No, just that's what we're here for. Is we're here to learn first. So our goal is to make these videos every now and then and get you guys this information, whether it be hot topics like Tesla's battery day, or now this EV Hummer, or just educational things about what is a dividend company. Maybe we'll talk about growth companies in the future. Just we're here to help you guys and kind of share what we've learned over the years and help you guys grow with us.
Yep, and hopefully we'll get better enough to where we can entertain as well. But with that being said, I'll go ahead and let everybody go. Thank you guys. We had one person view us for about 3 minutes of time, and now it's just you and me. But you guys have a great rest of your day. It is time to end. Goodbye.